Going into 2025, I did a video titled Why the Stock Market Could Crash Within 6 months. Then last week, I did another update and I told you guys maybe this is not the big crash that I was expecting. Maybe this is just a short-term pullback that's likely nearing the end. So I believe now I have a duty to update you guys on a lot of the things that have happened since then. We're going to look at many different points, many different charts, many different data, and try to determine if this is the start of a major bear market, a major crash could send us 20-25% down, or this is maybe just a short-term correction. There was maybe a lot of exuberance in the market, a lot of speculation, it has corrected, now we can go back up, make new all-time high. I'm going to look at all that stuff, and I really hope you enjoy it. Now, if we look at the NASDAQ is down almost 6% year to date. The S&P 500 is down 2% year to date. But many growth stocks like the Quantum AI, the SoundHound.ai, and so many others are down 20, 30, 40, 50, even 60% year to date, or from their all-time high. It's been a disaster. It's been really, really bad for the growth companies. But you just have to know that this is normal. Like over the last 2 years, companies like Nvidia, Apple, Amazon, even Tesla, they were outperforming. Companies like Verizon, McDonald's, Pepsi, they were underperforming. They were not doing too well. Now this year, the dividend stocks like McDonald's up 10% year to date. A lot of them are outperforming. And now a lot of the tech-oriented stocks, growth kind of companies, they are underperforming. And this is very normal rotation. And you should not be upset about that. It happens. Like it's not every year is going to be a 23% year or 24% year. You kind of have to lower your expectations a little bit because the average return is 8 to 10%. 8% on the S&P. We had 20% back-to-back years. Last year, I was up 54%. I know that wasn't sustainable. Now, I know a lot of you guys this year, maybe you're upset. You were up 18, 20% year to date. If you were in the growth stocks, now maybe you're down 10 or 20%. And I kind of got caught up in the same thing. I was up 18% year to date, now pretty much flat. So I lost all the gains for this year, but which I believe is not bad being flat versus the NASDAQ down 6% and me being up 54% last year. So I believe I'm still doing decent, but it could have been better. And, such opportunities, they're a good time to be buying a lot of those stocks. And then once we have another 20% years, then you're going to make even more money on the way up. So that's how you have to think about them. Now, having said that, I did show you guys a chart back from the 2022 stock market crash, and most crashes, they kind of play out the same way. That's why I love studying them. I studied in 1999. I studied them back all the way to 1929, and I tried to find certain similarities, maybe in chart patterns, maybe in investor sentiments that would tell me maybe something bad is coming, and those things, they tend to help me, have a certain cash position to take advantage of those companies on the way down. And this is what happened in 2022. We had a major pattern upward trend in the S&P. Once the trend was broken, this is when the algorithms and everyone started selling stocks, and we had the start of the 2022 stock market crash. And I know a lot of you guys believe that those things are just imaginary trend lines, they don't matter. But if you really look at them and you study previous crashes, they almost all played out the same way. And back then, just because I was open-minded, I made 27%. I saved a lot of money. A lot of people were down 50, 60%. And I was up 27% buying put options and many different things, which I don't do right now. But that's what I'm trying to tell you, is whenever you're open-minded enough, you could see certain things and you could act based on them instead of saying, oh, they don't matter because I'm a long-term investor. Yeah, that's all I'm trying to say. Now, right now, we have the same kind of breakdown. We had the S&P going up within a trend line, and we started going down, which is very similar to what has happened in 2022, and it's very similar to what has happened in previous crashes in the S&P 500. There's a lot of different similarities between right now and major tops or major crashes that we've had before. One of them, for example, was the massive involvement of retail investors in the stock market. And I normally use Robinhood to measure that stuff. In 2021, we had massive volumes and massive user pickup from Robinhood. I believe they had 4 million members back then. Now Robinhood has 25.5 million members, 25 million people. This is insane. They're on Robinhood. The US population is like 360. The adult population is like 220. 10% of them are trading on Robinhood. This is insane. And if you look at the transaction volume, it went up 200% in Q4. That was pretty close to where we topped in a lot of the different, growth stocks and many different things. And it's insane. And if you look at the volume, only 61 million was actually in equities and longer term investments. 222 million was in options trading, and 358 million were cryptocurrencies. And I'm willing to bet most of it wasn't Bitcoin. It was likely Doge or some kind of a meme coin that a lot of people were trying to get rich quick overnight trading. Anytime you see such investor sentiment and investors exuberance, investors behavior, normally those things that happen near the top, they don't happen near the bottom. So this is the first point we looked at. Another point we're going to look at is margin debt. This is my favorite indicator because once we are near a top, people have the FOMO, the fear of missing out, where you buy a stock and it keeps going up. So what you do is you borrow on margin and you keep margining your accounts. You could make more money. And there's a lot of greed. And such things, they tend to mark major stock market tops. We had the same thing back in 2021. I was highlighting it on YouTube, actually. If you look in October, we went above 4.4. Anytime you go above 0.4, it peaks in terms of investor sentiment with margin debt, and we tend to have a major pullback. The same thing kind of happened in 2018. We had the 2018 pullback. The same thing happened back in 2006, 2007. Once we went above 0.4, we went much, much more, and then we had the crash a year after that. Same thing happened in 1999, and the same thing is happening right now. Now, that doesn't mean that this is a major crash. We could still go much, much higher like we did back in 1999, and people take on margin and they buy the dips and do all these things. So I'm not saying that's telling me that there's a crash right now, but it's telling me that there's a potential of something major happening in the market that's much more than 2% down move on the S&P. Another point we're going to look at is the forward PE ratio on the S&P 500. It has reached the previous top of 2021, and now we're sitting at 21 times earnings. Now, again, that doesn't mean we're going to crash, but it also means that a lot of the stocks in the S&Ps are hypersensitive because they're priced to perfection. I don't believe all of them are. I believe Google is a bargain at 18 times earnings right now. I believe Amazon is a bargain at 19 times operating cash flow. But we had many stocks like Microsoft, which was trading at 34 times earnings, and Tesla was a little bit expensive, and Nvidia before was expensive, and we had some stocks that were kind of expensive. And that valuation is being corrected. And this is another point that's telling me that we're near some kind of a peak in terms of valuations. I don't believe we're going to go back to 15 times because we have better profit margins, better companies, amazing balance sheets, buybacks. So we're well positioned, but still the S&P is sensitive because the PE ratio is much, much higher than it was on a historical average. Something else that we looked at back then is the 10-year minus 3 months, which is an indicator of recessions and market crashes. And it has been accurate almost 100% of the time. If you look back in 2006, it goes negative. Once it starts turning positive, 6 months to 1 year later, we tend to have a crash. Same thing happened 99, 2000, then we had a crash. Same thing happened back in the 89, 1990s, we had a crash. And same thing even happened before COVID. Now we have the same thing right now, and we're pretty much flat to negative. Once we start reaccelerating, then we're likely near some kind of a market crash or near a recession. And this is another indicator that's telling me that, something bad could happen. Now, I don't want you to be scared because there's, some good things. One of them is this chart that's being shared on X, which is pretty much highlighting the Trump tariff 1.0 versus 2.0, and the same kind of pattern that we had in previous cycles when Trump was president. And we had a good start of the year, then we had weakness in March. After March, sentiment picked up, the S&P went back up, and then we went up. We did not have a crash, we didn't have anything bad happen, we didn't have a recession, we just went down a little bit, some excesses got corrected, and everything is fine. And I'm highly leaning towards that, and I believe there's a very high likelihood that this is the case right now, where we're not having a major crash, we're just having a decent correction in sentiment, and then we go back up. And if we're gonna have a crash, it's likely gonna come later on and it's not happening right now. Another point that backs this up, again on technicals, is the S&P 500, as I showed you, did break trend, which is not good, at all for the algorithms, and it's not good in general. But the Nasdaq is still within trend, and it has perfectly rebounded on this trend. The same thing has happened back in August. The same thing has happened back in October, November of 23, and it's been holding up in this trend, which kind of gives me hope that maybe this is not a major crash. This is just a sentiment kind of change, rotation in the market, way overdue. It has happened quickly. Maybe we're bottoming out and then we're going to go back up. The same thing that has happened in Trump tariff 1.0. This is where I'm personally leaning towards too, but I cannot be sure because I cannot time the market and I cannot predict the market. But based on all the data points that I looked at, this is most likely a minor correction. We're going to go back up, likely make new highs. And if we are going to have a crash, which there's a very high likelihood of it happening, it will likely happen later on, not right now. Now, I'm going to tell you what I kind of did in my portfolio. One thing I did is, and this is a rule that I have, is once the S&P 500 breaks trend, I take a lot of risk from my portfolio. For example, I sometimes have 1 to 2% of my portfolio in certain speculative stocks, maybe slightly profitable or unprofitable companies, and I have them as a small percentage of my portfolio. Sometimes I do certain call options on certain companies. Once we do break trend, I believe it's not the right time to speculate. So I take those things off and I raise cash. So I sell my options, I sell all those speculative names, and then I average down in the quality stocks. Like I've been buying Amazon, I bought Uber, I bought the dip on certain growth stocks down 30, 40, 50% from their highs. And I've been, slowly buying in. But I told people in my group, once we broke trend, this is the time to have cash, maybe 20%. And then we slowly averaged in and see what happens. If we go back in trend, then I was right on this not being a crash and everything is fine. We're going to go back up. But if we keep going lower, then maybe this is a crash and you should have some certain cash position and slowly buy in the market, not buying every dip. Not every kind of red day is a discount. And I just take my time and, I've done this many times. I've been through those things and I know how to manage them. And in order to manage them, you have to be open-minded. You have to be open-minded to listen to certain things, do certain things, not time the market, not believe that this is not long-term investing. So this is all noise. This is not the time to do that. You kind of have to pay attention to that stuff. If you don't have any cash, it's good to look at them and maybe try to have a certain cash position. So that's all I'm doing. I believe this is just a pullback that's nearing the end and it's going to be much, much better, but we're going to watch and see what happens. If you're interested in knowing more about what I do and how I manage certain things, I share everything I do in my own group. This is the link if you're interested. But thank you very much for watching. I hope you enjoyed it. If you did enjoy it, please press the like button and maybe consider subscribing. So I'll talk to you in another video.